I'm over $750 million in debt, and I pay no tax. So I brought my tax advisor here to explain how. So Eric, how? It also represents almost 10,000 apartments, right? So let's talk to people on how legally I'm able to defer tax.
There's a lot there, but I think the big point is, one, the debt is on real assets, but not only is the debt on real assets, they're on assets that the government favors, meaning that the government incentivizes you to invest in them. So there are tons of tax breaks that are available to those that own real estate. And you can maximize those with using leverage, because you can essentially get tax benefits using other people's money. So one of the big tax advantages that you get is what's called depreciation. When you purchase an asset, you get a deduction every year for a portion of that purchase price, regardless of whether the value changes or not. So even if the value goes up, you can still take these depreciation deductions every year. So by adding in debt, you can actually increase these depreciation deductions, which is a great tool. This doesn't just apply to Ken. Anyone can use this as long as you're checking all the boxes. I had a client that he had a lot of income this last year in 2024, and he's a real estate professional also. And he was asking me, what do I do? And I said, buy more real estate. And so he's like, what, for depreciation? I was like, yeah. So we literally backed into a number. We said, this is the taxable income you have right now. In order to offset that, you need that much in depreciation deductions. To get that much in the depreciation deductions, it means you need to buy a property of at least X purchase price before the end of the year. So that was literally the planning tool. So it not only helped him reduce his taxes, but it also, now he's got an asset, which includes debt, that will now increase in value in the future years.
Yeah, and I think it's important for everyone to realize that I meet with Eric, I see you probably once a month. We talk multiple times a month. And then toward the end of the year, usually around September, we really start getting intentional about with what can I do this year. So the things that you want to know in that September meeting are, what did you sell for the year? What are you buying for the year? What deductions and what kind of things do you want to acquire this year? What can you move to next year? What contracts can you move to next year? Can you buy this next year? Can you buy it this year? Like, all those things are things that we discuss. And they're all relevant, and they're all based around moving tax numbers from one year to another. Because there are some years where I actually have a lot of net operating losses, let's say from a prior year, where I might want to sell some things. So I can exit in one year because I have net operating losses from the last year, and I could pay net zero. Or maybe if I exit this year and I have a capital gain problem, now, of course, like your client, there's something I have to do differently. I have to acquire or buy like a billboards like I'm doing right now, where I get bonus depreciation, or even a jet. As you know, when Ross and I bought a jet, we were able to write that off in the year that we bought it. Even if you lease it or even if you finance it, that's the irony here. So the $750 million that we have in debt represents a couple $2 billion worth of assets. What people don't realize, or may realize, is that 750 is other people's money, but we're getting depreciation against it.
Yeah, it's incredible. Like, think about that. So essentially, $750 million, and that's getting depreciated. So you're in multifamily, 27 and a half years is the typical depreciable rate. So that's 750 million divided by 27 and a half is essentially, on a basic level, a depreciation deduction. But you can even do more than that, right? Because you do
cost segregation, and all these other things. And I think that's what people don't realize, is that you can literally go zero down and do seller financed or even bank financed 100%, and you're going to get depreciation. So essentially you're getting 100% of the money from someone else. In this particular case, we did, and of course, we're well below 50% loan to value. But what you get is you get the deduction against the asset, even if it's fully financed.
Yeah. And so depreciation is one of the big strategies, especially if you're selling something, right? If you have a capital gain, just like you were saying earlier, if you can find something else that offsets it with depreciation, that's great. Another strategy, right, is, and this is super common when either you don't want to own a specific property, but you still want to be in real estate, is use the 1031 exchange, where the IRS will allow you to exchange your real property for other real property as long as you meet their timelines and everything. And you will not recognize gain on the property that you sold. And so a lot of times this means you might be stepping up. So I've seen clients go from, right, and you've done this on multiple properties. In fact, you've even done, right, going from maybe a few properties into one larger
Yep.
property.
Well, we're doing that right now.
Yeah.
Yeah, like, so we have 5 properties that we actually have an institutional partner coming in because Ross and I wanted the equity. We're actually doing a kind of a closed door transaction at full market price, but we're taking 100 million of the debt and 100 million of the equity. Let's call it a $200 million transaction. And we're taking 3 of those projects and we're actually buying a brand new Class A building in North Scottsdale right now, all from 1031 money. So we're going to buy a building and I already have the equity coming from stuff that I already own. And that's just called the 1031 tax deferred exchange. I do have to keep all that money in an exchange account and I can't touch it because if I do, it's taxable. So it all has to roll in. But the point is once you really start to own stuff and you have a lot of equity and you have choices there too, right? You don't have to sell and then go find something. You can actually go find something and then sell and do it the other way around and take that money and roll it in as a down payment for something else. And by the way, you can do it. It doesn't have to be like for like. It doesn't have to be apartments for apartments. It can be apartments for a warehouse, right? It could be a warehouse for a retail office building or medical or hospital or whatever. There's all kinds of options here, right? I took an apartment building and I bought a resort in Sedona, which you guys, many of you have heard about, Orchard Canyon, which we own up in Sedona. That was literally from an apartment building that I sold.
Exactly. And if you think about it too, it makes sense, right? Taking the debt into equation, right? Because when you buy an asset, and if it's been anything like the last decade, right, that asset's increased. Assuming you haven't refinanced, you've got more equity in the property. Well, how do you kind of accelerate your returns? Take that equity and layer on more debt, right? So by doing an exchange, you can trade that equity into something else, assuming you don't want to refi. And that's why I say it's typically for when you don't want to own that specific asset for some reason, wasn't performing as well. It's not the class of assets. So you were in office and you've seen, well, office has been pretty stagnant or down depending on the markets, right? Now let's get into multifamily. So it's a really nice way to switch over. But also you can kind of layer on if you started in with 20% equity and now you've got 50% equity. We'll go trade into something else and get back down to 20%, as long as, taking into account risk and everything. But now you've got a larger asset. You can take more depreciation because presumably your cash flows on other assets have been increasing as inflation's gone up. You need more depreciation as time goes on.
I'll give you a great example. So Danielle bought a condo years ago for less than $200,000 in Scottsdale. And she's paid it off because she doesn't personally like that. But regardless, she paid it off. And now that thing's worth about $350,000. So basically she has an asset that's $350,000. But because it's in a condo project, there's all this competition on rent, right? And so she was getting $1,700, but now she's getting $1,500. And we started to take a look at her expenses versus what she has coming in. And I said, you're not really making much of a return when you have $350,000 sitting in equity, right? And that was a big light bulb moment for her because, even though it's paid off, but she still has taxes, she still has insurance, and she still has other things. And of course, she has the hassle, with it not being rented 12 months. Sometimes there's vacancy and those kinds of things. So we started to take a look at what was her net, right? And when you calculate that into her imputed equity, which in this case is $350,000, we know that, it doesn't make sense. So what she's going to do and what she's doing right now is she found a place where she wants to buy a home. So she's actually going to buy a home with a 2-car garage and a yard where the rents are in the 3 to 4,000 range. And then she's going to roll that 350 into a home. Now she's going to have a little bit of debt on that, but the little bit of debt, maybe a couple $100,000 at a really low number, is still nets her so much more. And that's the right way to use a 1031.
Absolutely. And it's just a good overall lesson on, hey, an investment may have been good at one point, but as the economics change, it's always good to reevaluate it.
Yeah, because what happened here was the condo price went up, but rents went up marginally.
Right.
That's actually what happened.
Yeah.
So now she's looking at the imputed equity that's sitting there, because that's real money just sitting there. And what's the return on it? No different than it was in a 1-month T-bill. You need to look at it that way. What am I netting on this 350? And where can I move that 350 to make more money? So that's how wealth. And by the way, Danielle's not wealthy yet, right? She will be. But, these are small little singles that she's been hitting, right? She has 5 of these. So the point is, you don't have to be wealthy to understand the concepts to be able to use some of these tools. And she's going to more than double the amount of income she has by just doing this 1031 exchange.
Yeah, it's a good lesson on that. And you're right, you don't have to be wealthy to take advantage of it. You're really focusing on the type of assets and the type of income that you earn, right? So obviously real estate is super highly incentivized by the government. Owning your own business has some incentives as well, but creating that kind of, we call it passive income stream, which, as you know, sometimes isn't so passive, but
actively passive.
Yeah, actively passive. But an important note about this too is that if you're just starting off, pay attention to some of the nuances too, because there are different rules for those that are actually real estate professionals versus those that maybe are actively managing versus maybe someone that is investing passively with someone like Ken, right? It puts you in a different set of rules. Now, if you are spending enough time in real estate, so say you can qualify as a real estate professional, and this is really good for people that are already maybe, brokers, or they're in the real estate business and maybe they're employees or they work for someone else, but they want to get started in real estate on the side. Well, you can qualify for the same advantages that Ken can. So if you go out and start investing in real estate and you're a real estate professional, you can use the depreciation and other deductions against your regular income if you're a real estate professional. And that alone is also a return, because you have to think about the tax savings when you're thinking about what your actual net in your pocket is, right? I mean, the tax rate is one thing. It's really about what lands in your pocket. So it's a big consideration.
Yeah. And so, back to the original point, which is, how do I pay little or no tax with $750 million of debt? Well, we're managing this all year. So when we sit down in September and we're taking a look at an asset, I'm literally saying to Eric, should I sell this year or should I not? And and there's a debate around it, right? It's all based around tax. And he said, well, this is a great year for you to exit this and take some chips off the table because you have these losses. Or no, this is not in your foreseeable future. You need to hold this a couple of years, right?
Yeah.
Those are real things that you need to discuss. You should not do it based on, you checking a market or a broker banging on you going, listen, I got to buy, or anything like that. This is all should be tax driven. In fact, there's so many times where we've gotten unsolicited offers, and sometimes Ross and I will go, well, we should, we got $20 million sitting in this asset. Maybe we should do something with it. And then we shoot it over to Eric and he's like, no, it's not the year to sell. Right.
Yeah. Especially if it's something where we're in the last quarter and it's like, okay, if you wait, maybe try and sell it in the first quarter of the next year, it gives you a whole nother year to come up with a plan. The other piece of it is it's not just the selling side, right? It's the buying side. We've got, are there depreciation deductions available? And the depreciation rules change every year, it seems like. So same thing, Ken will ask, hey, I'm looking at closing on a property, when should we do it? Especially if it's again in the fourth quarter. And if he's got too much in losses already. You can never have too many, tax losses, but it may be beneficial. Hey, let's push it to next year because we don't want those trapped in a limitation going forward. Let's try and put it in the year where maybe you've got more income. So we're constantly trying to match that. And it's basically all at the end of the day, it ends up being debt driven.
Yeah, it is. And it's funny because a lot of people try to do stuff before the end of the year. So I want to point this out. Who cares if it's December 15th or January 2nd? Like, that's 2 weeks, right? Like, that's actually what we're talking about here, right? We're literally just talking about pushing something from December to January 2nd or 3rd. And the tax differences are phenomenal, right? They can be dramatically different from one year to the next based on what you do. So, I'm not talking about taking something that I want to close in June or July. I'm talking about stuff in Q4, right? If you could push Q4 into Q1, maybe you should, maybe you shouldn't. But these are things, this is a way that we manage our tax. You really have to do that. Especially if you have investors, they're also part of this. So, to have to manage your investors correctly, you need this kind of tax advice because they also can be harmed if you're doing something in the wrong period of time. And we're, just by delaying things just a few weeks, and there's no buyer in the world or no seller in the world. If you say, listen, by the way, I've had this conversation a lot. If we have a tax problem, we need to close on January 3rd. It's almost 100% yes, right?
Yeah, unless they have a tax advisor on the other.
Yeah, right. Unless we're fighting, and then we just have a wrestling match between those two tax advisors. Eric always wins. So I know you wrote a lot about this in the tax strategies for everyone. Thanks for writing that book, first of all, and let's tell people about it.
Yeah, so I highly recommend picking up a copy. I go over in more detail about a lot of the strategies that we've been talking about, including debt and how it can fuel tax deductions. But I talk about other things too. If you're a W-2 employee or you've got a side hustle or maybe you're fully self-employed, I cover all kinds of things, including structuring the business, deductions you can take. And then I continue on with even going into estate planning, exiting assets, types of tax consequences there, how to reduce it, and then just finding your tax advisor, which at the end of the day is critical because you want someone keeping an eye on this just like you would having someone keep an eye on any part of your business.
Yeah, it's super important part of real estate investing or just owning a business. So if you guys are interested, just click on the link below.